You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Okay, happy Friday, everyone. The stock market continues to struggle, but what everyone's really looking at today is the fact that both technology stocks and cryptocurrencies, are cratering. In fact, it seems that every investment that has any sort of short-term performance, anything that seems to pop or get any kind of traction in the short term has a tendency to just pop and squat and head right back down again. And that's the kind of market we've been living in, but especially technology stocks and crypto. It's been a really, really rough year, and then most recently a rough couple weeks here for cryptocurrencies. So that's what we're talking about today. But first, as always, a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often. Feel free to subscribe. We're on both iTunes, for those of you that like to do the treadmill thing, listen in the car, listen on your walks. So we're on iTunes and YouTube for those of you who like to watch. Anytime we have charts and things of that nature, we always post them on our website at libertaswealth.com. So if you want to come back and look at any charts as opposed to just listen to me talking you through it, you can always check those out later or watch the YouTube video. And in addition, you can also follow me on Twitter at Adam Koch or Instagram at Financial Surgeon. Last but not least, like I said, all links, visuals, charts, and other educational resources are always available on our website, not just these materials for today's episode, but obviously other educational content as well. So let's go ahead and get started here. I always like to start with a quote of the day, as always. And our quote today is when I was talking to a friend of mine who's a big crypto trader down in Colombia. And he said, while I was talking to him about risk management and, looking at always putting risk management first before all else, because he's made quite a bit of money in cryptocurrencies over the years. And I was talking to him today, last night and this morning, and I said there's two types of loss. The first type of loss is loss of opportunity, and the second is loss of capital. So two types of loss of opportunity and loss of capital. If you lose an opportunity to buy something, you can always buy something else tomorrow, next week, or next month. But if you lose your capital, now you have no money to take advantage of tomorrow's opportunities. So I don't know who originally said this and who it's attributed to, but this is something that I've been repeating over and over again in speaking engagements, investment classes that I've taught over the years, financial planning classes going back to 2007. Because again, before all else, anytime you own an investment, you should always know where your stop loss is and what your uncle point is. At what point are you going to walk away? And doesn't even necessarily mean you're going to go to cash. Well, but at what point are you going to sell an investment that is no longer in the playoffs, a losing team with a losing record, and move on to a better investment that is exhibiting more strength? So today I didn't put a bunch of charts together in advance or anything like that. I just figured I'd talk you through what's occurred this past, call it 6 to 9 months in the market when it comes to technology stocks, which make up a huge portion of the S&P 500. Obviously, it makes up a good chunk of most of the NASDAQ, the Russell 2000. And as we look at how much the Russell has struggled this year, how much the NASDAQ has struggled this year, and then as we look at the S&P 500 and how it's pretty much gone almost nowhere in the last almost 2 months now we're working on, the question, of course, what's going to happen next? That's the big question. My opinion is that things are going to resolve higher. That's my opinion. I just think that there needs to be a little bit of time for things to digest, and things can digest in one of two ways. They can either digest through price or they can digest through time. When they digest through price, that means we see a market pullback or a market correction, a temporary but relatively shallow drop in the market. Whenever we have a digestion through time, what that means is we have a lot of this just choppiness and frustrated ups and downs, but generally nowhereness. I just made up a word there. So the first thing I want to show you today is just a relative rotation graph that gives a good idea in the U.S. anyway. So this is U.S. stocks, U.S. ETFs, so baskets of stocks here in the U.S. to give you an idea of like what everything looks like right now relative to the S&P 500. And as you can see, remember that for those of you who've never seen one of these before or who've never watched any of our videos or podcasts, when you look at a relative rotation graph, which we call them RRGs for short, and if you're listening on iTunes, picture a big square with 4 squares in it. The upper left square is improving versus the market. The upper right square or quadrant is beating the market or leading the market. The lower right square is weakening versus the market. And then the lower left quadrant or lower left square would be lagging the market. And when you put the benchmark, which in this case is the S&P 500, right smack dab in the middle, what you see over time is you can plot all these different types of investments in the U.S. market and see how are they performing over time relative to the market, relative to the benchmark, whatever benchmark you want to use. And then I can go back in time, and I'm going to go all the way back to 2018 here just for fun, but I'm going to go forward really, really slowly. And for those of you that aren't watching, for those of you listening on iTunes, what happens is relative strength tends to exhibit itself by seeing these investments, in this case ETFs, baskets of stocks, rotate for the most part in a clockwise fashion from improving to leading to weakening to lagging and then back to improving again versus the market. Now there's times when obviously there's outliers, but for the most part they have a tendency to move in a general clockwise fashion. And what we're seeing right now, so here we're at the end of my little animation here, and what we're looking at is things like cannabis stocks have moved out of weakening into the lagging quadrant. They're just getting beat up. Online retail, social media stocks getting beat up. Kathy Wood's robotics ETF getting beat up. Lithium stocks kind of trying to improve but sitting in this lagging quadrant and really struggling. IPOs, so new issues. Biotech. Kathy Wood's genomics and technology stocks. Solar stocks, which did extremely well last year, are just getting beat up. Momentum stocks, cybersecurity stocks getting beat up. So most of the investments, when you look at this relative rotation graph, and again, if you're listening on iTunes, most of these stocks and baskets of stocks are generally either A, already drastically underperforming the market, or they're heading in that direction. And when I say heading in that direction, what I mean is there are several baskets of stocks like blockchain, small cap energy, oil exploration, regional banks, small cap discretionaries, luxury goods, even uranium stocks, which have been a leader, and we own them, just full disclosure, in our clients' portfolios right now. We also own material stocks and steel stocks. Those are still sitting up there near the leading quadrant, heading out of leading into weakening. And many times what will happen is you'll see this jackknife process where an investment will head into weakening, but then it heads right back up into leading again, and that's a really good sign of strength. But anyway, so my point here is to say that most of the investments in the market, with rare exceptions, are generally weakening or already lagging and underperforming. The stuff that's doing well, the stuff that's starting to show some kind of strength, are things like consumer staples. Staples are the things that we need every day. It's like our shaving supplies and soap, things like that. Low volatility, so low vol. Gold miners and junior gold miners, which are just small cap miners, which again, full disclosure, we own in our clients' portfolios. Gold, which is not on this chart because it's a commodity, obviously it's not a stock, but gold and silver have been exhibiting some strength. So that was the first thing I wanted to show you, just to kind of give you a real nice picture. That's what's great about RRGs, is they can give you a great one simple picture of how there's a difference between the stock market and the market of stocks. The stock market, when you look at an index like the S&P or the NASDAQ or the Russell, there's a lot of stocks in there. And just because the index itself is doing one thing doesn't mean the stocks underneath the surface aren't doing something completely different. It's kind of like the health of an individual. If we might not feel unhealthy, but underneath there may be a disease that we've contracted, and we don't even know it yet until we go into the doctor, we get a scan, and we find out bad news. That's when you're looking at the stock market and you dig deeper underneath the hood, you can start seeing some of this weakness that's occurring, and that's pretty much what the theme of 2021 has been, with the exception of the first 4 weeks of the year, we'll call it, 4 to 6 weeks or so. So let's dive a little bit deeper here. I'm going to close this up, and we're going to head over and look at some individual charts. And I'm going to talk. Let's talk. You know what? Let's talk Bitcoin. Let's talk about Bitcoin and cryptocurrencies first because I've got blockchain up here. So one of the things right off the bat, looking at blockchain, these are stocks, a basket of stocks that have a heavy hand in the blockchain industry, and right now they're down off their highs almost 30%. And if you go back to yesterday, they were down as low as, call it, 36%. So that's blockchain. If we look at Bitcoin, and this is the Bitcoin ETF, this is not the actual cryptocurrency, so we're not looking at Coinbase here. But if you look at Bitcoin and how it's done recently, we had this nice big run. And I say Bitcoin, had a nice run off the bottom. We'll call it October, I'll call it the lows. So from October up to the top, up about 454%. Awesome, right? Sounds great anyway, and it is. And as long as you had an exit strategy in place. If you go back to July, at the July lows, then you're talking more like a 500% rate of return on Bitcoin, and this is the ETF again. But if you look at how things have gone since then, and it doesn't look like it on a chart that it's as bad as it is, but as of yesterday, the Bitcoin has been down as much as 50% intraday, and this has happened all in a very, very short period of time. So this is a 50-day moving average. The 50-day moving average is the average movement of any investment over 50 days or 50 periods. If it were 50 weeks, for instance, that wouldn't be days, that would be weeks. But this is a 50-day moving average. I always code it in blue because I like to say that if any investment stays underneath this blue area, I call that being underwater. And when we're underwater for too long, that's bad news for any investment. Doesn't matter whether it's a stock or a bond or a commodity, doesn't make a difference. And then I like to coin, it wasn't me who said it, I stole this from someone, but this daylight that occurs between the water and the peak. This is when we start to see a lot of daylight, a lot of space here between the 50-day moving average and price. Usually that means the market or the investment in question is ripe for a pullback. And then another thing I noticed here, actually I didn't even notice this until I was just kind of scanned down the bottom of the chart here, but you can see this negative divergence. Let's see if I can put a trend line on this. So here, this thing has been momentum, lower highs of momentum going back to the highs in January. So price was going higher in Bitcoin back in January while momentum was heading lower. And then, of course, price in this case ended up following momentum lower. Now we have the breakdown that we're dealing with right now. I would say a saving grace is that while I normally would like to see RSI bonds momentum bounce above 40, and it's already gone below that level, I think a saving grace could be if momentum can hang above 30 here. If it can not cross below 30, that would be positive evidence. I think also if Bitcoin can hold above this, call it $30 level, which was the lows from January, and then the highs or the short-term breakout here in December, that could be a good longer-term sign. But my feeling right now, I'm pretty bearish on cryptos in general. I just think that once you see a big move like this off the July or off the October lows, and something makes as much money as this thing has, you get a lot of people wanting to take profits. You get a lot of selling pressure, and as the old irrefutable law of supply and demand goes, if there's more selling pressure than buying pressure, then price must fall. And if there's more buying pressure than selling pressure, then price must rise, of course. And right now what we're seeing is obviously a very big imbalance of selling pressure over buying pressure. And at the end of the day, Bitcoin being a cryptocurrency, not a company with earnings, not a company with sales, and there's no fundamentals here aside from what somebody believes in this token. So it really is the epitome of human emotion, and what it's only worth what somebody is willing to pay for it over time. So that's crypto. Let's look at Ethereum. This is the Ethereum ETF. Gonna pull up. Oh, there we go. So this is a day old, and it doesn't look like much here, but you can see from the peak down to where it's at right now, 41% drop as of yesterday. So I don't have a live quote here, but as of yesterday, the Ethereum's down 41, almost 42% off its highs. Intraday was down yesterday as much as 43%. We'll call it off the highs just 1, 2, 3, 4, 5, 6 days ago was all. So again, lots of downside pressure, lots of sellers in the cryptos, and probably something that we want to be really, really careful of. I wouldn't be If I were somebody who was a crypto investor, I wouldn't be looking to try and catch any falling knives as these things fall. I wouldn't be trying to snatch them on the way down and treat it like it's on sale, like it's some big bargain. Instead, in any time you're looking at any investment, what you want to, in my opinion, what you want to do is you want to wait for it to base out. You want to wait for it to find a bottom first and then head higher, and then pull back maybe a second time. That's the conservative way to do it, and then head higher again. In other words, printing a higher low below which you could place an exit strategy that was more conservative, or you can use the first low as the hard stop, your exit strategy if you want to be a little bit more aggressive. But the way I'm seeing cryptos right now is, you gotta be really, really careful. You have to implement risk management. The volatility is insane. But let's stop talking about crypto. Let's change gears and let's talk about some tech stocks. So the stuff that did really, really well last year has really, really been struggling. And I'll just start because somebody I really respect in the industry, and I'll start by saying that so that I don't get any hate mail here. But Kathy Wood, who is the portfolio manager for the ARK funds. This is an ETF, a suite of ETFs that have done extremely well in 2020, but has not done so well as of late. So when you look at the sequence of returns, it can get pretty ugly here. Looking at the highs, which go back to February 12th, so like I mentioned earlier, tech stocks did really, really well right through about the first 6 weeks of 2021, and then ever since then, technology, which is a big, huge chunk of the S&P 500, has pretty much been gushing. It's just bleeding with seemingly no end in sight so far. And Kathy Wood's ARK Innovation ETF has been down as much as 36% off its highs in February, and as of right now, it's coming back a little bit, but I mean, it's still down 32% off its highs. It's underwater, as you can see here, again, if we're looking for something to buy here, and I'm not, but if I were, what I'd be looking for is for this thing to go up like this. And if you're listening on iTunes, again, we're looking for a higher low. So we want a low, then for it to go up, then for it to pull back again. So if it were to pull back and then stop, but stop higher than the first low, and then if it were to head higher again, then that's what we want to see. And we can put a line below the sand in the second low, best case, call it for more conservative investors, and then worst case below the first low, and then that can kind of give us a really good place to implement an exit strategy if we wanted to be a little bit more aggressive here. But the bottom line is, when you look at things like this, a lot of technology stocks. That's not what I wanted to do. A lot of the technology stocks are just getting really, really beat up, and I'm going to show you more here. So this is Kathy Wood's ARK Innovation Fund. Here is the ARK Robotics Fund. This is a basket of robotics stocks. And again, if I look at this going back to the peak, this one's been down as low as 25%, so not as bad. What about, let's look at Tesla. And ironically, Kathy Wood owns a lot of Tesla. Here's Tesla, which has really been struggling. So Tesla peaked out early this year, and then since then, it's down about 35% today, and it's been down as low as 38% off its highs. I can keep going. Amazon, this is an interesting one. So Amazon, you would think with a stay-at-home economy, work-from-home economy, you would think with all the shopping that was already being done online, not to mention Amazon's earnings have just been blowing out expectations. And I guess that's something else I should mention too, by the way, is that one of the things that's been happening that's very strange, and I don't want to say there's a mystery here because the answer is obvious in my opinion, but a lot of these stocks have been blowing out their earnings, and then instead of going up because they've been doing well, they've been going down instead. In other words, every time a good earnings report comes out, they're being sold into as opposed to bought. And when I say that the answer to that is obvious, what I mean by that is not that I'm some prophet or anything like that. I'm just saying that whenever you have the market telling you that when earnings are good, that people are selling those earnings, what that's telling me is that there's something wrong with the market. Or said another way, for some reason, and the reason really doesn't matter, there are more institutions and big smart money out there that are more interested in selling these stocks whether they have good earnings or not. If they have bad earnings and they fall, maybe Maybe they'd sell them anyway. We don't know because we have no idea what's happened with Amazon here. But you look at Amazon right now, and it's currently trading right around 3,200, 3,250 per share, and it is literally at the same point that it was in back in July 10th of 2020. Amazon was trading at the same place as it is today. So all it's done is chop up, down, sideways. Below water, above water, below water, above water. Really no daylight here to speak of. Maybe just recently a little bit of daylight here back in late April. But it's just fallen. Even since late April when it started to show some promise, it peaked out intraday at around 35.54 a share. And then it fell 11.8, almost 12% after earnings. And that's not the kind of environment that is indicative of a bullish, healthy uptrend. So kind of going back to what I was saying earlier, I think it would be completely normal to continue to see some digestion sideways in the market as we move forward until we can find ourselves a healthy uptrend. Here's another one, AMD. I'm just going to burn through a bunch of charts here. So AMD, again, similar story. Let's see, today AMD's trading about $76 a share or so. It was in the same place on July 30th of last year. So July of last year. We're talking, it's almost gone a year and it's gone nowhere. Let's look at some more here. Shopify, great company, great story. But again, here we are looking at prices trading about the same place they were in September. Just kind of sideways choppiness is all. We can look at some solar stock like Jinko Solar. Solar did really, really well last year. I was showing you the relative rotation graph earlier and how the ETF for solar stocks, TAN, T-A-N, has been one of the worst performers as of late. Look at this Jinko Solar here. So I'm going to take the price off the top, which was in, what was this, October 20th. The price peaked at about $87.65 a share for Jinko Solar. And then since then, it's been pretty much a cascade down, going down as low as 67%. And as of right now, at this very moment, down about 61% off its highs. Just because I'm on the topic, let's look at another solar stock, Sunrun. So here's Sunrun. Sunrun peaked kind of twice, you could say. It looks like it peaked in October in the first. Sunrun peaked again in January earlier this year. But what's it done since then? So since January, even though we are in an environment, in my opinion, that should be conducive to solar stocks doing well with a Democratic president that wants to implement infrastructure plans and clean energy, you would think these things would be doing well, but instead they did well in anticipation of the election. But pretty much since Inauguration Day, you're looking at Sunrun down 60, almost 61% at its lows and down about 58, 57% right now. If I pull up that solar ETF, TAN, T-A-N, it's going to look like a lot of these others. I mean, so let's just run this real quick here. So TAN, the solar, the basket of solar stocks, off its highs earlier this year, has been down as much as 44, 45%. And as of right now, at this very moment, it's bouncing, but it's not bouncing in a way that I would be all about buying this yet. I think that this still needs some more time. I think that technology stocks in general, the leaders from last year, I think they're going to come back into play. I think that there's still going to be an opportunity to rotate back into technology stocks and some of the stocks that did really well last year. But right now, solar's down 36.6% right now is what I'm seeing. It's underwater under a declining, so descending 50-day moving average. And then we can get into other stocks like, let's look at Palantir. Palantir is a great company. I still like it. I watch it literally every day because this is a company I think that has a bright future. But when you look at Palantir right now, off its highs, and I'm going to use closing highs, so off its highs, it's been down as low intraday as 55%. On a closing basis, it's been down as much as 52, 53%. And as of right now, at this very moment, down about 46% off its highs. Let's look at Peloton. Peloton had to recall so many of their treadmills, all of them, I believe it was. And Peloton was a great story last year, a great name, an investment that made a lot of money. But then you look at how it's done since January, since really actually more like December. And Peloton's been down as much as 51, 52%. And currently, as I record this podcast, this vlogcast, if you want to call it, down about 40% off its highs. Underwater, under a declining 50-day moving average, which is looking like it's starting to kind of base out a little bit here, but it's still early. Again, I still think this needs more time. Momentum's in a bearish regime. We've got crosses below 30. Momentum can't seem to get above 60, which would be bullish. It's not, which means that's negative evidence, obviously. Let's look at some more. We talked about TAN. Let's look at Zoom. So everybody uses Zoom these days, whether that be for work, meetings, or happy hour with your family. And Zoom, which again is blowing out numbers, doing really well from a sales and earnings standpoint. You look back to the peak, which happened, the peak of Zoom was in October on the 19th of last year. And Zoom is, as of right now, it's down at 321, so that would mean Zoom's down 43.7% right now as I record this. It's been down as low as 52%. And everybody's using it, and it's killing earnings, and it's killing sales. So it's kind of confusing, right? I mean, it's how is it possible that these things are doing so well but struggling so much? Here's another one, DocuSign. I mean, that's all we use at our office is DocuSign these days. We rarely send paper out unless we have a client who just doesn't do the whole technology thing. DocuSign is today trading at $195 and change per share, is at the same place as it was on the 4th of July last year. Same place. It's just done nothing. I can keep going down a list here. I don't want to hit all of these here, but let's maybe I'll change gears. Some things recently. Here's Kohl's. So here's an example of frustration. This is going to take a second to update, but Kohl's has actually done pretty well this year. Retail's open up the economy, retail type stuff. I guess we all have to buy new clothes to fit into our COVID weight adjustment. I guess I don't know. I know I do. And when you look at Kohl's here, it's been pretty much chopping sideways, going relatively nowhere since early March, and then all of a sudden today it gaps down huge. So let me look at this. It peaked out on what day was it? Monday, May 17th. So this Monday peaked out, and as of right now, it's down 15%. So here's a stock that was doing well, looking very promising. I will say, turn off my crosshair here, I will say this is a negative momentum divergence down here. Not a real clean one, but a divergence nonetheless. And that would have been a hint to tighten stops. But here's the problem. Whenever you have a gap down, which, and by the way, for those of you that don't know, whenever a gap down is when the market closes at 4 o'clock, the next morning you wake up and it's down 15% before the market even opens. As soon as it opens, you got, you can only sell it down 15. There's nothing you can do. You can't sell it overnight. So whenever it gaps down, there's really nothing you can do about it. You have to either say, okay, I'm going to put a line below my feet in the sand that says if it crosses below X, I'm out. Or you can say, I'm not going to hold on to this thing because I don't want to be a part of a stock that gaps down 15%. And on good earnings, let's just say, I don't know. But anyway, I digress. Let's talk about some things that look good. And I'm going to change screens here. All right, obviously this one doesn't look good. This is Nikola. This is another one I was going to show just to kind of show how crazy this past year has been when it comes to the stock market. This is a stock that was trading at around $10 a share, went up to $93, and is now trading at $12.64, but as low as $9 and change just recently this last few weeks. So no bueno. So some of the stuff on my short-term watch list that I'm watching, this is pretty volatile. Company called Callon Petroleum, but it's an energy stock, obviously, oil, gas exploration, and this thing's been just kind of chopping sideways. So you kind of have a range here. Above an ascending 50-day moving average, so that looks pretty good. But I would like to see volatility tighten up before I'd really have any interest in it. Here's a company called Vertiv. This is printing, publishing. Again, similar story here. We've got a rising 50-day moving average, higher highs, higher lows, kind of a base right here. Not the cleanest base in the world, but this would be a flagpole. This would be a flag. You could call it a pennant, ascending triangle. We can turn this into anything we want, really. I can look at this in a few different ways, but generally speaking, this is a pretty bullish stock. It's been holding up as the market's been struggling. So that's one that I'm kind of paying attention to. And there's a lot on this list right now, so I'm not going to go through all these. Here's one that's up 10% today alone. So obviously we wouldn't be jumping into this right now, but the market's been too choppy anyway. Like I said, it seems like every stock that looks like it's ready to set up to run ends up just squatting, whether the earnings are just killer earnings or not. So it's a really, really volatile market right now where, again, this digestion, this sideways movement is probably warranted just as caution. So maybe now's a good time to say this, because I actually was probably going to forget, but I think right now I don't see this as a red light market. I don't see a pending crash coming, next week, next month. I think that any once this consolidation resolves itself, that things should head higher. That doesn't mean it won't head lower in the meantime. It wouldn't surprise me a bit to see the market head down lower from here before it heads higher. But at least for now, I think that we have a caution light. I think we want to be careful. Our strategic models are always 100% invested, but our tactical models are sitting at about 50% or so invested is all, as we kind of put 50% of our gunpowders dry and ready to use if need be. Here's another good one. Meta Financial's looking good. Kind of again chopping sideways here. Here's a base here, and then here's another higher base. Just kind of tight movement. Signature Bank. So you see some financials in here. Signature Bank, kind of a nice little symmetrical cup here, and then we'll call this a handle. If this thing were to break out and head northward, that would be a good opportunity to kind of jump on this. Let's see. This is United Natural Foods. This is one I've been watching for a while. Again, you can kind of see a nice symmetrical sideways choppiness here. This would be a base right here. And then we kind of have this base on top of a base. And again, this has been holding up really well as the NASDAQ and Russell have been really struggling. Yeti's one that I like. We kind of have this, this big base here, kind of sideways movement for a few months. Then it breaks out and it's kind of heading down to, sideways with a downward bias right now as things consolidate. But if you look down on the bottom right here, we've got good earnings, good sales. Things look really good. Yeti long term. Ardagh, it's glass and metal company, packaging company, and their earnings don't look stellar necessarily speaking, but I do like the relative strength, and I like how the chart looks. But again, we don't own any of these. This is a really, really, really thin name. Thin meaning it only trades at 102,000 shares a day. So if I were to have any interest in something like this, we'd want to piecemeal our way into it. I don't want to go through all these. This is Diamondback Energy, which is, again, another energy stock. Here's airlines. Alaska Airlines is starting to set up, starting to see some sideways movement here. This looks decent. News Corp, which we own in our strategic models, also, again, kind of a nice flat base here, chopping sideways as the 50-day moving average has caught up to price while the market's been kind of heading lower, looking again at the Russell and the NASDAQ. Here's another one, Hope Bank Corp, another, regional banks. Nice sideways choppiness. When the market's going down, when we see tech stocks getting beat up like they have, when we see, big major market indices heading downward and struggling and bleeding, and then we see baskets of stocks or individual stocks or investments that are chopping sideways instead of going down with them, that's by definition, relative strength. That's a strong investment that you should pay attention to. Commercial metals. This is a material stock. Again, right here we kind of have this kind of a V bottom actually with a handle. I wouldn't really necessarily call that a cup. United Airlines, not as pretty of a chart, but still, again, starting to chop sideways. There's lots of airlines that are announcing expanded flights. And as the economy does open and people start traveling more, as there's more vaccinations, I think we'll start to see more and more of these open the economy stocks work out well. Why don't I stop there? And the last thing I'll show you is the current market climate, which is mixed. And that's really the best I can do. We've got some indicators that are positive. We've got some that are negative. So a very mixed market. And then this is my pre-flight checklist, I call it. And when I look at this whole dashboard under which it says safe for new entries, again, pretty mixed. But I would say that the evidence is still leaning red, leaning negative. as to whether or not it's safe for new entries, safe for new positions, which again, our strategic models are always invested 100% in the strongest relative strength, highest RS names, but the tactical models are still sitting pretty heavy in cash right now, sitting around 50% equity target, which is, and the reason for that is what we're looking at right here. The good news, though, again, is that short-term trends are up for the most part. Intermediate-term trend is up right now. Long-term trends are still looking up. Starting to see some weakness in the NASDAQ, some weakness obviously on the Russell 2000. When markets struggle, when markets crash, it's the small cap stocks that go first, then the mid caps, and then the large caps typically. So that's why it's important to look under the hood, look under the surface, and know when there's a green light, know when there's a yellow light. And of course, in my opinion, you never want to just slam on the gas and drive through downtown and hope you hit all the green lights. That's not the best strategy either. So I think we'll end here today. So that's it for today's show. Feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, remember, you never ever have to be a client to ask a question. If you'd like to set up an intro call or a Zoom meeting with me, just head over to our website to schedule something in our calendar. You can get access to our calendar on our contact page. There's a link there. You can also send us a message on our contact page as well if you'd rather shoot a message over and we can schedule something or just answer a question you have. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on both iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates as well as our other screencast videos and articles delivered directly to your email inbox. Feel free to follow us on Facebook. I'm also on Twitter at Adam Koch, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.